Hello and welcome. In this video, we will look at the long calendar spread. To place a long calendar spread, a trader buys a longer term call option on a stock, for instance a call option that expires in 2 months, and at the same time sells a shorter term call option with the same strike price on the same stock, for instance a call option that expires in 1 month. Usually a strike price that is at the money or slightly out of the money is used. For example, if stock XYZ is selling for $9.75, a trader might sell the $10 call option that expires in 1 month and at the same time buy the $10 call option that expires in 2 months. A calendar spread profits from the nonlinear time decay of an option. Each day, as an option gets 1 day closer to expiring, the non-intrinsic value of the option decreases as there is less time for the option to move to where it is profitable or more profitable. The daily loss of the option's value from time decay is not linear. As the option gets closer to expiring, the daily rate of decay increases and is greatest the last 30 days before the option expires. The trader profits from the fact that the option that is sold loses value faster from time decay than the option that is bought. A calendar spread is usually placed when time decay is at the maximum level for the option sold, and implied volatility is at a low level. The objective for this trade is that the value of the option that is sold decays and expires worthless, while implied volatility is increasing, helping to maintain the value of the option that is bought. Typically, this trade is closed just before the option that is sold expires worthless, with the trader both buying back the option that he sold and selling the option that he purchased at the same time. The goal is that the difference in price, which is collected, exceeds the original cost to place the trade. The trader profits when the stock price remains close to the strike price during the life of the option that is sold. The profit is highest when the stock is exactly at the strike price when the option that is sold expires, because the option that was sold expires worthless, while the option that was bought has the highest possible non-intrinsic value. The profit begins to decline as the price of the stock moves away from the strike price. If the price drops below the strike price, the option that is sold still expires worthless, but the non-intrinsic value of the option that was bought begins to decline. The trade begins to lose money if the price of the stock drops far enough from the strike price that the difference between the premiums drops below the amount paid up front to place the trade. In other words, the trade loses money if the stock price drops far enough below the strike price that the amount collected closing the trade is less than the amount paid to open the trade. If the stock price rises above the strike price, both options begin to have intrinsic value. The trader will still close the trade by buying back the option that he sold and selling the option that he purchased at the same time. As the stock price rises away from the strike price, the non-intrinsic value of the options decline. If the price of the stock is above but still close to the strike price, the trader will still close the trade for a profit by buying back the option that he sold and selling the option that he purchased at the same time. However, just like if the stock price declines down far enough, if the stock price rises up high enough, it will hit a point where the non-intrinsic value of the options decline enough that closing the trade results in an overall loss for the entire trade. If the trader ends the trade by closing both options at the same time, his maximum possible profit is the difference between the amount he collects closing the trade and the amount he paid to open the trade. His maximum possible loss is the amount he pays to open the trade. So that is the long calendar spread. In the next video on this subject, we will look at some examples. I hope that you enjoyed this video. Thanks for watching.